Today, the RBA lifts again. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news. Well, at today's meeting, the board decided to increase the cash rate by a further 25 basis points to 4.1%, and has also increased the interest rate paid on exchange settlement balances by 25 basis points to 4%. And the RBA said that inflation in Australia has passed its peak, but at 7% is still too high, and it will be some time yet before it gets back into the target range. This further increase in interest rates, they say, is to provide greater confidence that inflation will return to target, well, within a reasonable time frame, whatever that means. High inflation makes life difficult for people and damages the function of the economy, they said. It erodes the value of savings, hurts family budgets, and makes it harder for businesses to plan and invest, and worsens income inequality. And if high inflation were to become entrenched in people's expectations, it would be very costly to reduce later, involving even higher interest rates and a larger rise in unemployment. Recent data indicates that the upside risks to the inflation outlook have increased, they said, and so the board has responded to this. And while goods price inflation is slowing, services price inflation is still very high and is proving to be very persistent overseas. Unit labour costs are also rising briskly, with productivity growth remaining subdued. And they went on to say that growth in the Australian economy has slowed and conditions in the labour market have eased, although they remain very tight. The unemployment rate increased slightly to 3.7% in April, and employment growth has moderated. Firms report that labour shortages have eased, although job vacancies and advertisements are still at very high levels. Wages growth has picked up in response to the tight labour market and high inflation. Growth in public sector wages is expected to pick up further, and the annual increase in awards wages was higher than it was last year. At the aggregate level, wages growth is still consistent with the inflation target, provided that productivity growth picks up. The board remains alert to the risk that expectations of ongoing high inflation contribute to larger increases in both prices and wages, especially given the limited spare capacity in the economy and the still very low rate of unemployment. Accordingly, it will continue to pay close attention to both the evolution of labour costs and the price-setting behaviour of firms. The board is still seeking to keep the economy on an even keel as inflation returns to the 2 to 3% target range, but the path to achieving a soft landing remains a narrow one. A significant source of uncertainty continues to be the outlook for household consumption. The combination of higher interest rates and cost of living pressures is leading to a substantial slowing in household spending, and house prices are rising again, and some households have substantial savings buffers, although others are experiencing a painful squeeze on their finances. And there are also uncertainties regarding the global economy, which is expected to grow at below average rates over the next couple of years. And the RBA closed by saying that some further tightening of monetary policy may be required to ensure that inflation returns to target in a reasonable time frame, but that will depend on how the economy and inflation evolve. The board will continue to pay close attention to developments in the global economy, trends in housing spending, and the outlook for inflation in the labour market, and the board remains resolute in its determination to return inflation to target and will do what is necessary to achieve it. Now, interestingly, on the same day, the ANZ Roy Morgan Weekly Consumer Confidence Survey came out, with overall confidence falling another 0.4 points to 75.8%. That's well below the long-term monthly average of 111. It's also the 14th consecutive week that the Consumer Confidence Index has been below 80. Commenting on the results, ANZ's senior economist Adele Turnbull said that consumer confidence is in deeply negative territory, with confidence about future financial conditions falling to its lowest level since the start of the COVID outbreak in late March 2020. The time to buy a household item index, which more closely tracks with retail sales, also remained deeply negative, below 70 for the 17th straight week. And meanwhile, Australia's Misery Index, which has tracked inflation, interest rates and unemployment in Australia since the 60s, jumped by almost 220%, compared to a 62% increase in the 12 months to the start of the GFC in 2007 and 8. According to Guam Lim and Sam Tassalis of the University of Melbourne, Australia's misery index is now just shy of the level reached early in the global financial crisis. During the September quarter of 2008, the RBA maintained official interest rates at 7.25%, unemployment was 4.2%, and inflation was 4.8%. And Liam predicted that the misery index will remain elevated, adding that while inflation has fallen slightly in recent months, both the unemployment rate and the official cash rate has risen. Thus, Australia's army of mortgage and rental slaves are facing a dour period with rising mortgage rates, rents and energy prices, falling real wages and rising unemployment. So the question, of course, you've got to ask in the context of all that is, how does this play into the inflation story? Because it's clear to me that the RBA is still set on its path of further lifting rates if necessary. And what does this do to house prices? Because, of course, there's been a bit of a boost, but my feeling is that this could be the pivot back to a lower scenario again. And as you know, I've been holding to the view that home prices are likely to go sideways or lower over the next couple of years. Nothing in this data changes my view, and I think the false dawn that we saw over the last couple of months may well dissipate. But the bottom line is this. Pulling the interest rate lever higher is going to hit 1/3 of households. That still leaves another third sitting without any mortgage and with savings, and a third in the rental market also being hit potentially by higher rents. So we will see some further bifurcation between those with and those without. But for those with a mortgage and for those with a rent, the troubled times are with us for some time to come. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. Now, Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.